Welcome back. You're watching The Money Show, and this is the Meet Your Fund Manager segment of the show. I like this segment particularly because it gives me an opportunity to showcase the men and women who manage the funds that you invest in, so that you can hear the philosophy that they employ when they manage those funds. It gives me pleasure to introduce Sailesh Bhan, who is Deputy CIO of Equity at Nippon India Mutual Fund. Thank you so much, Sailesh, for taking the time. We'll be talking about the three funds that you manage: the Nippon India Multi-Cap Fund, the Nippon India Large Cap Fund, and the Nippon India Pharma Fund. But let's first get into the philosophy, because I'm sure that there is a philosophy that will tie all of that together for the investors and prospective investors in your funds. Can you help us understand?
I think generally the investing approach has been to try to keep the process a little simple and approach it more from saying, how we can pay reasonably for good quality businesses. So it's like buying, I would say, sustainable, profitable growth businesses at reasonable prices has been the approach. And this strings across all the three products. And more importantly, it's an approach which possibly allows us to take the right risk, because at various points of time, markets go ballistic on either side, and you need to be rational around that time. So I think growth at reasonable prices is what allows us to stick to, I would say, what allows us to be able to navigate through markets over the last several years. Another important aspect which runs generally through all the three products is the fact that we do focused high conviction investing in a few specific areas where we think outlier opportunity exists from a 1 to 3 year horizon based on fundamental and deep research. And I think this element also is visible in the sense a lot of stocks we have held for 10-15 years, and they have compounded for us over this period of time. If you look at our portfolios over the last several years, you would find several holdings we have stayed invested where the compounding ability of those businesses remains, and they continue to grow in a profitable manner and a sustainable manner.
Understood. Before we get into the sectoral allocation that you have, or the exposure to the sectors that you have in the two, the multi-cap and the large cap, I want to ask about the multi-cap and the transition to multi-cap. A lot of your peers chose to go into the flexi-cap option that was provided by the regulator after the change in regulations. Why is it that your fund house and you chose to go in the multi-cap route? Isn't it less maneuverable in a situation like what we are right now, where you're seeing broad-based selling, particularly on the broader end?
Well, very interestingly, this fund nearly has completed 16 years. And over the period in the multi-cap space, we have actually remained in all the three categories, the large, mid, and small cap space, in each of the last 15, 16 years since inception. So the strategy has remained the same, and we have retained the same character going forward. So for investors, there is no big negative surprise which comes from the change in style in the particular product. So I think we have retained the same character which we have been running the fund with in the last 16, 17 years since its inception. Secondly, the fund construct, given that it was following the same multi-cap approach, where being present in all the three categories, the amount of change to meet the new regulations was not very significant. And that also enabled us to do the transition very smoothly and comfortably.
Interesting. And that I'm sure is something that is going to be watched very closely by a lot of your investors and a lot of my viewers. In case viewers, you were not familiar with this is where you have equal allocation, 25, 25, 25 to large cap, mid cap and small cap. Okay, that's done with. I want to talk about where we stand right now, Sailesh, because we're talking at a time when there is increased volatility in risk assets, not just here in India but globally. And that correction that you were expecting, that a lot of people were clamoring for, has indeed taken place. How are you positioning yourself, one, and how are you viewing the fundamental scenario?
Any big shifts have happened in the last 12, 18 months on the fundamental business side as well. I think in addition to the excess liquidity and all, which led to elevated asset valuation, there have also been shifts in the business environment. You have to view the Indian economic conditions way different from the international, situation. In India, we had 5-7 years of very weak earnings prior to fiscal 20 because of all the reforms which were being done, because of the problems of the past, the NPA issues and things like that. I think we have transitioned through that phase very well, and now we are seeing the benefits of reforms flowing through. Large sectors which suffered because of the reforms, like RERA impacted the real estate sector, they are all back to normal. So power reforms are improving demand environment as well, manufacturing reforms, lower taxation for new capacity creation, lower corporate taxation, all of them are helping, and the PLI scheme and all that are creating many layers of growth across many large sectors, which was a big missing piece in the last 5-7 years. So when you put this in context, India's economic growth should be on a reasonable wicket from the next maybe 12 to 36 months or 12 to 48 months point of view. I'm in no way saying that the COVID has not had any impact in terms of incomes. We certainly have had a lot of negative impact also in terms of incomes for a large cross-section of population in India. And I think hence consumption might be on a weaker wicket, while investment can be on a much stronger wicket, because these are coming from two different balance sheets in the economy. The investment is coming from corporates who need capacity, export growth has come back, better profitability is improved for them, and their balance sheets are stronger and underinvested. And that is where I think the investment theme over consumption seems to be a lucrative theme, depending on, based on the valuations where these two segments or categories trade at today.
You seem in your large cap fund to be bullish on financial services. You have over a third invested in these names, and the frontline names in the private banking space, HDFC Bank, ICICI Bank are among them. What are the factors that you anticipate will lead to an outperformance? Because I'm guessing that you anticipate an outperformance.
Interestingly, the banking sector space has got 2 or 3 big fundamental shifts which are there. One, the consolidation which has been happening in the last several years is even more visible. The market share gains by these large players is fairly substantial. Second, you're finding that the COVID-led challenges have been managed very well by all these larger players or larger banks in the system, versus, like I said, the damage has been in the middle India or lower middle India, where the exposure for some of these larger financing banks have been fairly limited. So on a wicket from a balance sheet point of view, they're very, very strongly placed. They are very, very strongly placed from a point of view of being positioned for all the investment-led growth which will come, which will require lending. And I think today they are consolidating because the near-term growth outlook is a little weak, because it takes a bit of time for credit growth to accelerate. But I think they're well positioned from a 1 to 3 year kind of an horizon. Consolidation supporting them, very strong balance sheets coming out of COVID, and the investment outlook opportunity which exists in the next 3 to 5 years should support the banking sector. Hence the overweight or the conscious larger exposure in the specific space.
Okay. I want to also talk about the Pharma Fund, Sailesh. And it's a really interesting theme. I look at the constituents of the Pharma Fund, and you have all of the frontline, or rather quite a few of the frontline names, and quite a bulk of the fund allocated towards the frontline names. Sun Pharmaceuticals at close to 11%. What is the reason why you've stuck to these names? What are the opportunities that they present? You don't want to go towards the API theme that a lot of people were crying hoarse about a year and a half back?
Interestingly, pharma is a unique sector. It is unlike, say, a monolith sector like a cement or maybe some other sectors which have single variables driving profitability of those sectors. In pharma, you have got many sub-layers to each company, right? So when we evaluate pharmaceutical businesses, we think an element of critical mass is very, very important. You need companies to reinvest upfront in terms of new product creation, in terms of filings, because all this whole process takes about 3 to 5 years. So generally we have found that larger businesses have one ability to invest. All these larger businesses have close to 3,000 to 5,000 crore to 7,000 crore of operating profit. So their ability to invest for growth is high. Second, their ability or the probability that they comply with global regulations or they comply with manufacturing practices only moves up because you need to keep on investing for that, training, investing for that. So that is also there. And third, more importantly, a lot of these businesses serve across a larger cross-section of markets. So you've got business growth coming from India, coming from emerging markets, coming from developed markets, and allows for the diversity which is there. So somebody builds a particular product pipeline, we can actually monetize it across markets. So the preference for larger companies comes from that, and also the fact that larger companies' valuations have been pretty normal. This sector had very difficult times till about 18-24 months back, and I think valuations of larger companies themselves have remained very attractive, giving very little advantage to move to smaller companies which make much lesser profits and are dependent on a few products for their return. So I think the risk reward in this space still appears to be very good, and that is why the positioning is towards the larger spaces. Selectively, we have certainly participated in hospital space, in smaller businesses, in a diagnostic space, in smaller businesses, where we find that sustainability of those businesses and the growth prospects have remained attractive.
Sailesh, a couple of the headwinds that have been pointed out for the pharmaceutical space, and indeed the ones that cater to large markets in the US, is the fact that there is pressure on pricing and in terms of the FDA scrutiny of the plants that they operate. Is that something that they will have to contend with? Do you see that the companies that you have selected are better placed to do that?
See, all this is a function of what kind of investments the company is making in its compliances, what kind of investments the company is making in its product portfolio creation. The chances that these larger businesses are better placed to handle this is certainly way higher than smaller companies, because it's quite an effort to deal with global regulations, comply with them at all the times, and more importantly, repeat the same quality processes for a long period of time. Even if there are some one-off issues, a lot of these companies have 5-6 plants, right? So if you have one plant having a manufacturing issue or a process issue, you find the ability of the company to manage through the crisis far, far better. So this is one construct. Second, coming to the pricing part, yes, you have seen after a sweet spot of about 6 to 9 months last year, we have seen excess inventory in the system, which has led to significant pricing pressure for a lot of the pure US-oriented commodity generic businesses. I think in a quarter or two, the pressure from this should ease. Will it come back to pricing growth? No, but I think the pressure of declines, which has been higher single digit and all that, should normalize, which is enough, because then you'll have new products coming in, providing some kind of support and recovery for growth. So I think it's a problem which has been there for the last 2 quarters, and maybe another 2 quarters of that challenge might be there for some of these businesses which have a dominant US commodity exposure.
Sailesh, a couple of last questions. One broadly on earnings. FY23, do you have enough visibility to say that you see improvement even from this point, considering that I think the Omicron hopefully is not going to be as disruptive as previous variants? How do you see FY23?
FY23 should be in my opinion, a modest year. I don't think a very, very strong recovery, at least in the early part of FY23, seems to be possible, because we've had a significant amount of pent-up demand already getting into the system. Also, a lot of the investment orientation with the Indian economy is moving towards, where large companies looking at investing and things like that. Maybe order books will start showing up faster, and real on-the-ground investments will take about 12 months to 18 months to play out. So I think the broader earning recovery, the easy earnings are there. I think it is now, you will have some pockets also suffering because the pricing pressure of commodities is just hitting them. So maybe 1 or 2 quarters of weaker earnings in the next 4 quarters is a very high possibility. I think real normalization of earnings will be FY24 onwards, where we think we will be supported by the investment phase of the large corporates in India, the mid corporates in India, which will all in all also take away the distortions which COVID has created. So I think normalization of earnings should be from the second half of FY23 and FY24 onwards.
My last question to you, and this is perhaps an opportunity for you to speak to some of your younger investors who've started maybe a couple of years back. Any New Year guidance, any New Year advice that you would give them going to the new year?
I think most of the investors who have actually come into the market in the last, say, 12, 18, 24 months have had a very, very good experience with equities, because the returns have been very good from a equity market point of view. However, I think the fundamentals of equities are they go through cycles, they go through their own ups and downs. And I think having a reasonable plan on how much you allocate to equities over a medium term, I think will matter a lot. Most returns are made when markets are in a challenging phase, because that is where when you invest you get maximum amount of returns and the risk then is lower. So in equity markets, when you find it less risky from a market level point of view, actually it is only when the prices are in your favor. So I think whenever you have difficult chances, allocate more to equities while you keep allocation normalized when you reach higher levels in terms of valuations. I think this is one cycle which will allow investors, this is one strategy which will allow investors to stay longer, because the longer you stay in the market, I think the probability of success actually keeps going up. I think this is what I have. And equities possibly are one of the best available asset classes in which you can really participate in the strong long-term opportunity that the country presents. So I think it certainly deserves to be a part of every investor's medium-term portfolio.
Great advice, great words of wisdom, which I think a lot of my viewers should take to heart. Thank you so much, Sailesh, and wish you and your team a very happy new year from all of us here at ET Now.
Thank you very much, and wish you all a very happy new year and a great 2020. Thank you so much.
All right, that brings us to the end of this conversation, but there's more on the other side of this break, so do stay tuned.